School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 5 Emerging Issues in Accounting, Unit 15 Human Resource Accounting, Part 2.
The organizational goal of wealth maximization requires allocation and administration of resources. Allocation and administration of resources require quantification, and in the absence of quantification, allocation may be distorted, leading to suboptimum decisions by managers. This is particularly relevant for intangible resources like human resources. However, empirically, it is not yet established that human resource accounting information helps management make optimum decisions that may be impacted either way in presence or absence of human resource accounting information. Investment decision. The presence of HRA information in the financial statements may change the way in which the investment decisions are undertaken by managers and creditors, including banks and financial institutions. Especially in the context of outside investors and asymmetric information, the HRA information will influence the performance assessment of companies and eventually affect their judgments. HRA information makes a difference in investment decisions, but the correlation between HRA information and adopted investment decisions is still unclear. Another aspect is the differentiation between non-financial and financial HR information. HR information in the financial form, that is HRA information, influences corporate investors' decisions, whereas HR information in non-financial form has considerably lesser influence. HRA information is relevant and influences optimal investment decisions, and often inputs for HRA is the original cost method. Human resource planning. Human resource planning is the process for acquisition, utilization, improvement, and preservation of human resources of an organization. From a strategic perspective, HRP or human resource planning is defined as the process by which management determines how an organization should make from its current manpower position to its desired manpower position. HRA figures or information can assist managers in developing a cost matrix for measuring the cost of recruitment. This cost matrix guides managers in choosing the best alternative selection process. Simultaneously, HRA plays a role in internal personnel management, employer turnover management, layoffs, and design of performance evaluation measures. The figures coming out of the HRA exercise influence and aid in the decision-making process by providing information on specific HR tasks such as training, assessment, and development. One of the major challenges in using HRA in HRP is the absence of information and objective monetary values of HR variables. For example, the loss from employee attrition or turnover cannot be assessed, as the value of employees is known only to their immediate work group, and that known value is also subjective. Performance Management System or PMS. Performance Management System or PMS is the systematic approach to measure and manage employees' performance in light of the predetermined organizational goals. PMS is used to support decisions in the area of training, career development, and layoffs. PMS process starts with setting clear and specific performance expectations. Next, the achievements are measured, followed by formal and informal feedback. The main element of PMS is the measurement process, and HRA provides the input for the measurement process. The various categories of human resource investments are costs associated with recruitment, hiring, orientation, training, and integration with the existing workforce. These estimated costs provide input to estimate the replacement cost of workforce at various levels. This estimate of replacement cost goes into the planning of workforce acquisition. HRA can be used as an alternative accounting system to measure the cost and value of employers for management decisions like training and development. For training and development purposes, HRA information can be used to gauge the potential worth of individuals, and if a reasonable improvement is not seen after training, resources can be directed to those employees whose potential and performance could be enhanced. For a well-functioning and reliable evaluation process to operate, HRA can provide inputs regarding the value of individual employees of an organization. Training and development. For an organization to maintain a competitive advantage, continuous training and development programs are required. For these programs to be successful, the management shall be able to assess the value of these programs and estimate the expected payoffs or return on investment. In order to estimate value expected payoffs, HRA is an essential tool through which cost can be measured for alternative training programs and in choosing the best alternative training programs. Compensation management system. Compensation management is the process of establishment and implementation of policies, programs, and practices that determine the salary, incentives, and benefits each employee receives. A good compensation management system should follow a systematic and scientific approach that should result in a fair, equitable, and logical compensation. Information from HRA can be used by the salary administrators through which they can design the salary structure in a fair, objective, and transparent way. Another aspect of HRA is that it also affects the employee bargaining power both within and outside the organization. HRA information allows rewards to be administered based on a person's value and utility to the organization. HRA information can be used for wage revision and salary reviews. Human Resource Accounting or HRA measurement models. Human resource value is an extension of the concept of the general economic value of resources. As the contribution of tangible resources started declining in the economic returns and the contribution from non-tangible started increasing, especially from human resources like technology, qualified and highly skilled, need was felt for generating information regarding the valuation of human resources and consequently accounting for this information in an alternative way. In traditional accounting, all the expenses related to human resources are debited to the profit and loss account of that year, whereas the human resource expenses are treated as revenue expenses. In the various alternative methods of HRA, the human resource expenses are treated as capital expenditure, whereas the whole expenses are not taken to profit and loss account. However, only a part of the expenses are taken to the profit and loss account, and the rest of the expenses are taken to the balance sheet as assets, which is to be amortized over a period of time. This time period will depend on the useful life of the human resource asset. The information regarding the value of human resources is a key input for managerial decision making and internal management. Apart from this, the information is used by investors, creditors, financiers, and government agencies for their purpose. Various approaches are developed for measuring the value of human resources factors in nature and the use of such data. Methods to account for human resource value are classified into two categories. Number 1, methods based on cost, and number 2, methods based on value. Methods based on cost. In accounting, the term cost is used in varied ways, including historical cost, replacement cost, current cost, direct and indirect cost, fixed and variable cost, and standard cost. The most common way cost is understood is in terms of the sacrifice made, something foregone to acquire an asset or service. Conceptually, all cost will be either the component of expenditure or asset. An expense is a cost consumed during the current accounting period, whereas asset is the portion of cost that is expected to generate economic benefits in future. The fundamental problem in HRA is the measurement of the component relating to expenditure and assets. Benefits or returns from cost can be deferred and extended over a period of time. The cost-based models are based on the cost of human resources to the organization. This approach involves the computation of the organization's investment in employees. The categories for which the cost is computed are acquisition cost, training and development cost, welfare cost, learning cost, separation cost, and other costs. These costs are capitalized and amortized over the useful life of the asset. As a result of capitalization, the human resource cost is recorded as an asset rather than as an expense. Consequently, only the cost amortized will appear in the profit and loss account, and the remaining cost will appear in the balance sheet as an asset. Based on cost, there are certain methods that are used for human resource valuation. This model was developed in 1967 by William C. Pyle along with R. Lee Brummett and Eric G. Flemholz. As per this approach, the various costs incurred in the human resource investment subsystem is categorized into 4 groups. Number 1, acquisition cost. Number 2, training and development cost. Number 3, welfare cost. And number 4, other cost. The actual cost incurred on these 4 categories is capitalized and amortized over the expected useful life of the human resource. Before we move further, let us understand the meaning of capitalized and amortized over a period of time. Human resource expenses are revenue expenses and are taken to profit and loss account of the period in which they are incurred. In human resource accounting, these expenses are not treated as revenue expenditure but as capital expenditure. When an expense is treated as capital expenditure, the expenditure is not charged to profit and loss account but taken to the balance sheet as an asset, is written off in the form of depreciation, amortization, and this portion or amortization is charged to profit and loss account. Now let us briefly discuss the various subcomponents of the 4 subcategories mentioned so far. Acquisition cost. The cost incurred in acquiring the human resources suitable for the job in question is called acquisition cost. Acquisition cost consists of the expenses incurred on recruitment, selection, hiring, and placement. Acquisition cost is the cost of the whole process of acquisition of human resources and is just not limited to the cost associated with the selected human resource, but also include the cost associated with the persons who were not selected. Acquisition cost basically comprises of recruitment and selection cost. Recruitment cost. It is the cost incurred to identify the human resources suitable for a particular job, both from within and outside the organization. The selection cost is the expense incurred to determine who should be selected out of eligible human resources. The cost of selection varies according to the position for which a person or persons are to be selected. Generally, for higher positions, selection cost is high. Selection cost includes administrative cost of application processing, conduction test, interview, and consulting fees of the selectors. Hiring and placement cost are also part of the acquisition cost. These costs are incurred to bring human resources to the organization and place them on the job. Training or development cost. Training and development cost is aimed to bring a change in employees' skills, knowledge, attitude, social behavior so that their improved ability enhances the productivity potential both at the individual and organizational level. The cost of training includes on-the-job training, formal training, and special training and development programs, welfare cost, and other costs. These costs are incurred by the employers to provide the employees with an atmosphere that is conducive to good health and high morale, thereby increasing productivity. The expenses related to this are the cost for welfare amenities within the organization and welfare amenities outside the organization. In a nutshell, under the historical cost model, the expenses related to the human resources are clubbed together and capitalized and subsequently amortized over the useful life of the human resources. Replacement cost approach. This approach was propounded by Rensis Likert and further developed by Eric G. Flemholz, based on the concept of replacement cost. This method can be used as an alternative or as a supplement to the historical cost method. This method involves the measurement of cost to replace the firm's existing human resources to find the value of the existing human resource. Opportunity cost method. Hakimian and Jones proposed this method of human resource accounting to arrive at human resource valuation. In this method, different divisions are involved in a competitive bidding process for scarce employees. The bids are based on the perceived value of the employee and their utility to the division. The successful bid price is the value of that particular human resource, and the bid price becomes part of the investment base. The main drawback of this method is that it is only able to value scarce human resources. Standard cost method. This method was suggested by David Watson. In this method, the standard annual cost of recruitment, hiring, training, and developing the employees in particular grade is taken into consideration to calculate the value of human resources. The total standard cost for all employees is the value of human resources. Value-based models. Lev and Schwartz present value of future earnings model. This model, developed by Lev and Schwartz in 1971, is based on the extension of the economic concept to the human capital and is defined as the income of the specific human resource over a period of time, which is discounted at a certain rate, usually the cost of capital for the firm or the returns generated by the firm, to find out the present value of future incomes. This method calculates what an employee's future contribution is worth to the organization today. In this model, the value of human resources is estimated as: number 1. Employees are categorized into specific groups according to their age and skills. Number 2. Average annual earnings are determined for different age groups. Number 3. Total compensation till retirement is calculated. And number 4. The total compensation calculated is discounted at the rate of cost of capital. This model has several limitations. First, the value of an employee is measured in terms of salary, which may not be a true indicator of an employee's worth. Secondly, this model ignores the probability of separation of employees from the firm other than death or retirement, leading to an overstatement of employees' expected service life and future earnings. Thirdly, this model ignores the change of role of employees within the organization itself. And lastly, the model fails to incorporate various variables such as seniority, skill, and experience. Flemholz Stochastic Rewards Valuation Model. This model was developed by Flemholz in 1972. This model is an improvement over the Levy and Schwartz model as it takes into consideration the probability of employees moving from one role to another and leaving organization before death or retirement. As per this model, the value of an employee to an organization is the expected realizable value of an employee or expected value of achievement. Present value of net benefits obtained, Morse model. This model presented by Morse in 1973 suggests that the value of human resources is equivalent to the present value of net benefits derived by the firm from the service of its employees. This method of valuation of human resources involves certain steps. They are: number 1. Estimate the gross value of services likely to be rendered by the employees in future. This estimation is based on the individual and collective capabilities of employees. Number 2. Estimate the value of the future payments to the employees. Future payments include both direct and indirect payments. Number 3. Determine the excess of future value over future payment. And number 4. The value of human resources for the organizations is the present value of net benefits, which is found out by discounting the excess of future value over future payments as calculated in the previous step. The value of human resources to an organization is equal to the current value of the future services offered by the employees. Mathematically, this is expressed in a certain manner, where A equals to value of human assets to a formal organization, N equals to number of employees, Y equals to current time, T equals to highest time at which an individual currently employed leaves the organization, I in bracket T equals to net value of the services rendered by individual I at time T to the organization. Hence, the equation becomes I in bracket T equals to GI in bracket T minus EI in bracket T. GI in bracket T stands for gross value of services rendered by individual I at time T to the organization. EI in bracket T stands for all direct and indirect compensation given to individual I at time T by the organization. X in bracket T stands for value of the services of all individuals currently employed working together in excess of the value of their individual services at time T, and R equals to discount rate. Hermansen model. Hermansen is one of the first to address the issue of HCA. Hermansen in 1964 suggested two methods of assessment of human resource value. The first one is Hermansen's unpurchased goodwill method, and the second is Hermansen's net adjusted present value method. Hermansen's unpurchased goodwill method. This theoretical model is based on the assumption that the value of the operating assets must equal the present value of future services that these assets provide. In order to estimate the value of the human resources, this model considers variables related to the economy in which the firm operates and the business level activity of the firm. These variables are the average profitability of the sector in which the firm operates, the average value of assets held by the firm, net profit, and return on assets. In this model, it is assumed that firms are going to earn a normal rate of return on their assets. Now, if the firm has any different rate of return, it is assumed that it is due to human resources. As per this model, the value of the human resources is in excess of actual profit earned at a normal rate of return on the total physical assets owned by the firm. Now let's summarize the unit. There is an increasing demand for accountability regarding the value creation by the human resource function. The management is interested to see a link between HR programs and the company's bottom line or profit. Investing in people and providing appropriate HR interventions, initiatives, and solutions can result in an increased and sustainable bottom line over a medium horizon. However, the problem is that there is no direct link between the bottom line and HR function. This problem partly arises from the fact that HR investments are treated as revenue expenditure rather than as capital expenditure. In the absence of any direct correlation between HR interventions and bottom line, and in addition to lack of measurement of benefits of HR intervention, it becomes difficult for managers to decide for which program to invest, how much to invest, and whether a particular program adds value or not. Human resource accounting is an attempt to address some of these issues. The basic premise of HRA is that expenses related to the development of human resources are capital expenses. They should be treated as an asset because the gains from human resource development are going to accrue to the organization for a considerable period of time. Various techniques have been developed to value human resources. One set is based on the cost incurred and the other is based on the value calculated by discounting the future earnings of the human resource.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.